Welcome to This Explainer. I am so thrilled to have you here today. Think about this. Every single day, we've got billions, literally billions of dollars in goods floating across our oceans, rolling down our highways, and flying through the sky. So what keeps this incredibly massive, totally chaotic global logistics machine from just completely collapsing the second a storm hits or a ship runs aground? Well, today we are unpacking the massive, invisible financial safety net that keeps global trade moving. We're talking about marine cargo insurance. We're going to get into the weeds and be as detailed as we can, but keep it as simple and relatable as possible. Let's get started.
Okay, let's dive into this. How do you even begin to put a price tag on a risk that you can't physically inspect, moving through a highly volatile environment handled entirely by third parties? It sounds absolutely terrifying, right? But insurers have actually engineered incredibly rigorous mathematical ways to tame all that chaos.
Here is our roadmap for today. We're going to look at evaluating global shipping risks, take a peek inside the shipping container, lay down the rules of premium payment, compare single versus continuous coverage, and finally, check out some specialized cargo insurance policies.
Section 1. Evaluating global shipping risks.
Picture yourself as an underwriter. Someone just asked you to insure a $50 million shipment. Evaluating that kind of risk actually requires profound, boots-on-the-ground common sense. You really have to know the physical realities of the world. For example, underwriters look very closely at the nature of the commodity. Take hygroscopic goods. Now, that's really just a fancy industry term for things that absorb moisture and melt into a giant liquid mess. Think salt or caustic soda. Obviously, you can't insure a mountain of salt the exact same way you'd insure solid steel beams. On top of that, underwriters have to factor in port conditions, the social and political climate of the destination, and, of course, the specific details of the vessel carrying the goods.
And speaking of the vessel, there's one tiny detail insurers watch like a hawk: the ship's flag. All vessels fly the flag of the country they're registered in, but some choose to fly what's known as a flag of convenience, or an FOC. These are vessels registered in countries where the rules of the game are, well, suddenly relaxed. We're talking minimal requirements for crew competency, very loose regulations, and super low taxes. For an insurer, an FOC acts as a massive red flag. It just dramatically spikes the risk profile of the entire voyage.
Another major factor here: age. The number 15 is absolutely crucial. In the marine insurance world, a non-liner vessel is generally only considered a good risk if it's under 15 years old, and that's assuming it operates on a regular advertised route. For tankers, it's even stricter. They cap it at 11 years. Once a vessel crosses that specific age threshold, the underlying math of probability fundamentally alters, and believe me, the premium rates are going to reflect that extra danger.
Section 2. Inside the shipping container.
So zooming in from the macro risks of the open ocean right down to the cargo itself, we know containerization made global shipping infinitely safer and faster, but it is still wildly vulnerable to human error. This usually happens in two specific stages. First, you've got the commercial stage, which involves actually declaring the cargo. Misdeclaring something hazardous in a mountain of paperwork, that can literally lead to disaster. Then there's the operational stage, the actual physical packing and stowing of those containers onto the ship. A single mistake in either of these stages can trigger a catastrophic, cascading chain of failures.
And this brilliantly illustrates what happens when the operational stage goes completely wrong, a terrifying phenomenon known as hogging and sagging. Today, most container lines rely on automated stowage software to plan exactly where the heavy boxes go. But if operators treat this software like a computer game and just stack way too much weight in all the wrong places, the physical ship itself can warp. The hull literally bends under the mismatched weight. It just goes to show, even in a highly digitized world, physics always wins.
When things go wrong physically, what is actually inside those steel boxes matters immensely. 3,500, that is the staggering number of hazardous cargo types listed in the IMDG code. That's the International Maritime Dangerous Goods Code. Moving chemicals safely across the ocean isn't just about dodging a fine. It requires incredibly precise packaging, strict quantity limits, and exact markings. When you've got 3,500 different types of dangerous materials floating around out there, strict compliance isn't just bureaucratic paperwork. It is, quite literally, a matter of life and death.
Section 3. The rules of premium payment.
Now we're shifting gears from physical risk to financial rules. So the crucial point here is how these premium payments are legally structured.
In the Indian Insurance Act, for instance, there's a very strict rule called Section 64VB. This rule explicitly prohibits an insurer from assuming any risk whatsoever until the premium is actually received or officially guaranteed in advance. In the high-stakes world of marine insurance, there is simply no such thing as, "I'll pay you later." If you don't pay up front, you do not get the safety net. Period.
However, the system does bend just a little bit to accommodate the messy, practical delays of international trade. Under Rules 58 and 59, there are some specific relaxations for marine cover notes. For exports, you can pay the premium within 15 days from the date the overseas vessel actually sails. For imports, it's within 15 days of receiving the overseas declaration. Basically, this gives businesses just enough breathing room to sort out their chaotic international logistics without suddenly losing their coverage.
Section 4. Single versus continuous coverage. Now, what's really interesting about this is how big companies actually handle all that paperwork. If you're a company shipping hundreds of times a year, buying an individual policy for every single transit is an absolute administrative nightmare. Instead, they use continuous coverage. An open cover is kind of like a subscription service for international trade. It's an unstamped agreement that provides automatic, continuous cover for imports and exports, and you just declare your shipments as they happen. An open policy, on the other hand, is a bit more like a prepaid account. It's a stamped, legal document meant for domestic trades, lasting exactly 12 months, where you pay up front based on your estimated annual turnover and you draw down the balance as you ship.
But hey, insurers aren't crazy. They do not just hand out unlimited blank checks. They use very strict limits to act as emergency brakes. A limit per bottom caps the absolute maximum value the insurer is willing to risk on one single vessel. Meanwhile, a limit per location caps the value they'll insure if cargo starts piling up at a single pre-shipment port or a warehouse. These limits are absolutely crucial. They prevent total financial ruin for the insurer just in case a single megaship sinks or a massive port happens to catch fire.
Section 5. Specialized cargo insurance policies.
Okay, let's talk about some sniper-like policies designed for very specific problems. Say you're importing a massive shipment of tea leaves. You insure it for its standard cost. But what if the market value of tea absolutely skyrockets at your destination and you were just about to lock in a sweet 10% profit? Well, if that ship sinks, your standard policy only pays for the base cost of the tea. That is exactly where increased value insurance comes in. It's a secondary policy that literally covers the profit you were anticipating making. It makes sure you don't lose out on a massive market upside just because of some random transit disaster.
Then there's the seller's contingency policy. Imagine you ship goods all the way across the world, and mid-transit, the buyer suddenly rejects them and just refuses to pay. The goods are legally yours again, sure, but they're floating in the middle of the ocean. This policy is a safety net that protects the seller against physical loss in that exact scenario. And here's a crazy fun fact. The insured is legally forbidden from disclosing the existence of this policy to anyone. It adds this wonderful little bit of spy novel intrigue to the normally dry world of logistics.
For the massive global corporations, you've got the Annual Sales Turnover Policy, or AST. Think of this as the absolute VIP package of marine insurance. Instead of meticulously tracking individual limits for imports, domestic buys, and exports separately, this policy acts as a seamless ultimate umbrella. It bases the premium entirely on the company's total gross sales turnover. It drastically cuts down on administrative headaches because the insurer is looking at the macro health and total output of the company, rather than counting individual steel boxes.
And lastly, we have Marine Advanced Loss of Profits. You usually see this issued alongside project insurance. Imagine a massive new factory is being built, but a custom, highly critical turbine falls off a truck during transit. The entire factory construction grinds to a halt. The cargo policy pays for the broken turbine, sure, but what about the millions of dollars bleeding out because the factory opening is delayed? This policy covers those massive resulting financial losses, usually kicking in after a 30-day time excess rule.
So let's bring this all together. This quote from our source material really hits the nail on the head. It says, "The transaction of marine insurance calls for sound common sense and knowledge about the nature of commodities. Behind all the complex math, the strict legal statutes, the limits per bottom, and those specialized turnover policies is an intimate, firmly grounded understanding of the physical world. Evaluating risk requires knowing exactly how salt melts, how ships bend, and ultimately, how humans make mistakes."
Which leaves us with this final thought to ponder. We rely so heavily on automated stowage software and massive digitized supply chains. But as we've seen today, physics, weather, and human error always have the final say. So it really begs the question, In an era of supercomputers and AI logistics, are human common sense and intimate global knowledge still the ultimate safety nets, keeping our world moving? Thank you so much for joining me on this explainer. I really hope this gave you a newfound appreciation for the incredible, hidden architecture of global trade. Keep learning, and I'll catch you next time.